Hey, what's going on, guys? Welcome back to another episode. It's been a while. Apologies. A lot has transpired, and I've kind of been devoting a lot of time to a lot of different opportunities, and it's been kind of difficult to kind of like cherry pick which one we wanted to talk about. And so I did come across one opportunity or situation rather that I think is very interesting. I think it's one of the more interesting opportunities that I've come across just personally. And I wanted to bring it to your attention, largely because, or primarily because, if you were to just kind of hone in on one segment of this business, Biglari Holdings, ticker symbol BH for its Class B shares and Class A shares, ticker symbols BH-A. If you were to just hone in on its investments business and you strip out the total aggregate debts of the company, you get a net asset value of something like $392 million versus a market capitalization as of the date of this recording of about $196 million. So that implies something around 100% upside. And so that kind of begs the question, is this in fact a value opportunity? And so when you come across, or when I come across something like that, I think it kind of warrants me to dig a little deeper. And I kind of wanted you to come along for the ride for you to decide for yourself, is this a value opportunity? So without further ado, let's kind of go ahead and just unpack this stock. Okay, so at the beginning, I talked about its investment portfolio. If you go ahead and take a look at the company's cash and you look at the company's investments, they aggregate to about $663 million as of the end of first quarter 2019. Now, if you strip out the total debts on aggregate for the company, you get a net asset value, not including its four operating businesses. You get a net asset value on its investment portfolio and its cash of approximately $392 million. And now, as I referenced again in the beginning, the market capitalization for this company is about $196 million. Quick note about that market capitalization calculation. Typically, what you would do is you take the share price, you multiply it by the shares outstanding to get to the market capitalization. What's interesting about this particular scenario is that Biglari Holdings indirectly owns a substantial portion of its own shares through its investment partnerships. And so factoring those shares out, because they mimic and behave much like treasury stock, the market capitalization is adjusted to roughly about $196 million. Again, like I said in the beginning, that's roughly about 100% upside. And you might wonder, okay, is it fair or is it logical to assume that the share price should trade in one-to-one parity with its underlying assets or its underlying investment assets? I think that history can kind of shed some light on that question. And so if you were to look at the last 10 years, the company's shares have traded at a substantial premium to its net asset value. So I think that may answer your question. So the next logical place I think I want to bring you to is kind of laying the groundwork for you to understand who is the man Sardar Biglari, what's his history, and what is the structure of Biglari Holdings. So Sardar started his career really as an undergrad student. At the time, with his friend, with $15,000, he started an internet service provider company called INTX Networking, which he, in 1999, sold for an undisclosed amount to a competitor. That sale seeded his next venture in investment management, where he opened up the Line Fund and also started accumulating shares in a restaurant chain called Western Sizzlin'. Eventually, he actually took majority ownership of the business, gained a board seat, and outright owned the entire restaurant chain. And leveraging that investment, he actually went ahead and made a successful investment in Friendly's, which he in short time was able to reap roughly about an 80% return within about a year's time. And while also simultaneously utilizing those profits to be able to invest into Steak and Shake. Steak and Shake, for those of you who aren't familiar, is another restaurant chain that has a large presence in the South and also in the Midwest of the United States. And so he took on, his style of investing was to be a very aggressive activist investor, where he would gain a board seat, and then really revitalize and reorganize these kind of sleepy restaurant chains. So today, Sardar Biglari owns approximately 55% of Biglari Holdings through Class A and Class B shares. Moving on to Biglari Holdings, the company, what you need to understand is that it's separated into two business segments, really. The operating business and the investment arm. And within the operating business, you have four wholly owned subsidiaries, two of which I've already mentioned. Steak and Shake, which is the largest restaurant and most critical asset in the Biglari Holdings portfolio, or the largest operating business, rather. And then you have Western Sizzlin'. And then in 2014, the company, utilizing the cash flows associated with Steak and Shake and Western Sizzlin', Biglari branched out into investing into insurance, property casualty insurance, and commercial trucking for a company called First Guard and its affiliated agency. And also, and pretty surprisingly, he branched out into owning Maxim magazine. I do want to emphasize that Steak and Shake is the largest and most critical operating business because it's been the cash cow or the cash machine that has allowed Sardar to be able to make these diversified investments. And so that's kind of in a nutshell the operating side of the business. Just a few quick notes. Western Sizzlin' is a profitable entity, but it's substantially smaller than Steak and Shake. So in terms of earnings and cash flow contribution, it pales in comparison to what Steak and Shake has been able to kind of move capital up in terms of the parent, into the parent rather. And now First Guard doesn't really, while it is a profitable and growing business, it's a spectacular business from my view. It doesn't move any cash out of the insurance segment. It actually retains all of its earnings, largely because it wants to improve its capital strength, which in turn supports its underwriting business. It doesn't have to cede a lot of insurance premiums back to some reinsurers, so it's kind of helped that business grow at a consistent and compelling rate over these last 5 years. Now, Maxim magazine, it's unlikely that it generates any cash for the parent company because it's been largely a loss-making entity since its acquisition in 2014. Biglari Holdings has invested probably about over $40 million, and it wasn't until 2018 that segment first generated its modest profit of about $1 million. So that's kind of, I just wanted to shed some light on the operating segments themselves. And then moving on to the investment arm of this business, what you need to understand is that Biglari Holdings has substantial investments which are managed outside of itself in Biglari Cap Corp, which is Sardar Biglari's privately owned investment management company, which in turn manages the Lion Fund LP, and then also the investments held in Lion Fund 2 LP. So one interesting thing to note about these two funds is that BH actually owns about 90% of the assets held in these funds. And if you actually go ahead and do a little digging and research and pull up the 13F filing for Biglari Capital Corp, which manages these two funds, roughly about 76% of the assets are devoted to one company, Cracker Barrel Old Country Store, ticker symbol CBRL. That has been a wildly successful investment for Sardar over these last 10 years. Another 26% is devoted to Biglari Holdings. So, like I said before, when I was referencing the market capitalization calculation, Biglari Holdings indirectly, through these partnerships, the Lion Fund and Lion Fund 2, owns a substantial portion of its shares. So 26% of the assets of these funds are devoted to owning BH. Now, so collectively between those two stocks, that represents about 98% of the assets. So total assets as of the most recent 13F filing were about about $1 billion or so, give or take. I think the last thing I want to note about the investment portfolio is that, Sardar Biglari, he does manage it through his investment management company. If you were to look at historically what he's done for the company on a NAV per share basis, he's actually compounded it at a rate of about 27% annually, which is quite exceptional. That's Buffett-like returns. And so that's just looking at the investment portfolio alone. Aggregately, if you look at the whole company on a book value per share basis and a tangible book value per share basis, he's been able to grow the company at a rate of something around 10% over these last 10, 11 years. Okay, so moving on to what's the story here? What's the situation? Why is the stock price kind of in the doldrums, or why is it in these trough valuation levels? So one thing that I kind of want to point out is that while Sardar is, in my view, quite an able and shrewd investor, he's no Oracle of Omaha. And to clarify what I mean, Sardar has actually sown a lot of seeds of discord between himself and his shareholder base, which is something that I don't think Buffett would do. So first and foremost, what notably comes to mind is back in 2013, Biglari started moving in earnest investment assets that were housed underneath Biglari Holdings, and moved them into the Lion funds. And so by doing so, he opened himself up to incremental incentive compensation. So he now entitled himself, since those investment assets are now being managed by Biglari Capital Corp, he's now entitled to 25% of profits above a hurdle rate of 6%. So what that really means is, let's say the fund 1 year appreciates in value above 6%, say 10%. That means that 4% excess return, he'll pocket 25% of that. So that's kind of that's how he was able to kind of accord to himself, or earn for himself, additional compensation. And the reason why that's so controversial is because those funds were previously never assessed any fees whatsoever. It's there were no management fees, there were no incentive fees associated with those investments prior to him moving those assets. So it's kind of like, imagine Warren Buffett. He takes Berkshire Hathaway's $176 billion portfolio, moves it over into Buffett Partnerships, and now says, I'm charging this 25% return fee of anything above 6% annualized returns. You can't imagine him doing that. It's not something he would do. It's especially at the expense and cost of shareholder value. So that was kind of a really controversial move. Later on, he would actually most recently in 2018, when the stock price declined some 55%, he got the board to approve unlimited compensation for his salary. His salary was previously capped at $10 million, and now that cap was removed, leaving shareholders kind of confused, like, hey, wait a second, the stock price just dropped in a really meaningful way, and now you just removed all caps on your salary. And another really notable move that created or fostered that kind of level of this enormous level of discord between him and shareholders is the implementation of a dual class structure, the A class and the B class shares. So the A-class shares, while they're entitled to 1 vote per share, and they are entitled to the economic benefits of the company, the B-class shares are entitled to 1/5 of the economic profits associated with the A-class shares, and they're not entitled to any votes whatsoever. And part of the reason behind why Biglari went through that process was because he wanted to solidify control over the company, and he wanted to be able to leverage the B-class shares to be able to acquire other companies later down the road without sacrificing any ownership interest in his own shares. Those corporate governance issues have kind of left investors enormously dissatisfied, and I think that's most reflected in what's occurred with the share price most recently. So on top of these corporate governance issues, Steak and Shake has been seeing really deteriorating financial results since 2016. In the first quarter alone, although the company manages 413 restaurants and franchises another incremental 213 units, the company has seen or generated losses of approximately $19 million in the first quarter of 2019 alone, versus a full year 2018 loss of approximately $11 million, and in 2017 generated a slim profit, almost break-even results. And so, the reason why that's a critical issue is because, like I stated before, Steak and Shake has been the primary cash generating enterprise for the parent company. Now, in the most recent 10-K filing, if you look at the risks section of the filing, the language in the risks has now changed, where now it states that Steak and Shake, due to certain restrictions in the debt covenants, can no longer distribute cash up into the parent organization. On top of that, allegedly, Sardar Biglari has mentioned in the most recent annual meeting in April 2019 that he's got a very limited time frame to turn around this business. He's got until approximately March 2021 before allegedly $184 million debt maturity is coming due associated with Steak and Shake's business. Based on my math, if you look at the 10K filing, I think it's closer to $209 million. He's got this major maturity coming due, yet not much time to turn around the business. And so, if Steak and Shake were to fall into bankruptcy or liquidation, that could have some severe or material consequences on the wider organization of Biglari Holdings. Furthermore, given that the company has kind of indicated that it's shuttered, at least temporarily, some 60 store locations or restaurant locations this year, losses could actually accelerate into next year, which exacerbates the situation. And to make matters even worse, roughly 286 managers in the St. Louis market area have filed a lawsuit and successfully won the lawsuit against Steak and Shake that they were unfairly compensated and that they were not paid overtime pay. And so the restaurant operation is actually going to have to owe approximately $7.7 million to those managers. So that's going to again further exacerbate Sardar's efforts to turn around this particular business. So taking all of these issues in consolidation together, the corporate governance issues and this issue around Steak and Shake and the possible insolvency of that business, the stock price in both the Class A and Class B shares have dramatically fallen since their introduction in April 2018. As a matter of fact, the Class A shares have declined 45%, while the Class B shares have declined 53% as of the day of this recording. Yet with all this being said, and with all this pessimism baked into the price, therein lies the interesting investment opportunity. It's kind of opened up this really incredible pricing discrepancy between where the prices are today as of the date of this recording versus the net asset value per share of this company. Okay, so now thinking about the valuation of this business, I assigned a net asset value calculation of $392 million for Biglari Holdings. I got there because I took the cash balance and it took the carrying value of all of the company's investments and then subtracted out the debts to get to the $392 million. I didn't include the valuation associated with the 4 operating businesses. Now, if you wanted to do the technically correct way of valuing this particular business, you'd have to conduct a sum of the parts analysis in conjunction with probably some other evaluation approaches like the discounted cash flow or DCF. So if you wanted to do the sum of the parts analysis, what you'd have to do is arrive at comparables analysis for each of the 4 operating businesses: Steak and Shake, Western Sizzlin', First Guard, and Maxim Magazine. And then you'd have to add back the cash and the value of the investments, and then subtract out all the debts to get to the net asset value calculation. I took the shortcut route where I just didn't include the valuation associated with the 4 operating businesses, because my assumption was that although Steak and Shake currently is a loss-making entity, the other 3 businesses are not. They're actually, especially First Guard and Western Sizzlin, they're healthily profitable. And so I kind of did the quick and dirty and did just the valuation of the investment arm of the business, and then stripped out total debts to get to the NAV. A case, I think, if I'm honest with myself, if you have a loss-making entity, that could be a reason for a conglomerate discount, which is a fair assessment. But I'm gonna circle back to that part of the conversation as far as why a valuation discount or a conglomerate discount may not possibly exist or shouldn't exist later on in this conversation. Okay, so now moving on to the risks associated with this company. Yes, there is an apparent upside potential of about 100%, but the fact that Steak and Shake is teetering between solvency and insolvency has enormous implications on the wider business. So if Steak and Shake continues to approach bankruptcy or liquidation, Sardar could actually go ahead and start taking capital away from other parts of the business and reinvest them into this, what could be an inevitably failing business, thereby reducing the value of the net asset, the value of the NAV. That $392 million could very well be much less than that if he starts taking money away from or liquidating portions of his investment portfolio to simply try to restructure this business, which, if it ultimately fails, that value's gone. Now, if Steak and Shake does in fact fall into liquidation and insolvency, what that implies is that Sardar's range of optionality just shrank in a really meaningful way. He's not going to have the cash flows to be able to make investments and to make to kind of finance his investments through the Lion funds going forward. So, the growth prospects could be somewhat limited. In addition to that, if the capital strength of BH shrinks and diminishes in a really, really meaningful way due to the loss of this business, that has also implications on First Guard. First Guard, the insurance company, could likely no longer be able to take on the level of risk that it has been able to over these last few years, these 5 years, and it may have to start ceding more premiums back to reinsurance companies, which will have a negative implication on the growth of earnings for that particular unit. Now, most critically, in my view, if Steak and Shake is taken off the table, Sardar may be wedged into a position where he could be forced or deeply pressured to make an acquisition. And simply because he needs that cash flow to get this model running like the way it historically did. And so if he does that, he could very well likely liquidate the treasury shares that are held inside Lion Fund and Lion Fund 2 in order to finance an acquisition. So what that means is that the shares outstanding number changes in a very dramatic way and almost entirely eliminates the pricing discrepancy between the NAV versus the current market price. So that could have some negative implications on the stock. Other risks that come to mind include if Sardar actually goes and takes additional steps to increase his compensation at the expense of shareholder value. In addition to that, another critical risk is if the largest investment that BH has made, which is Cracker Barrel, if Cracker Barrel actually deteriorates in value in a really meaningful way, that's going to obviously have negative impacts on the NAV calculation. Okay, so moving on to kind of the later portion, the last portion of this conversation is this is a really interesting idea or situation, and the reason why is because there's a rebuttal to some of these risks, and especially the main risk involving Steak and Shake. And the first rebuttal is that the parent company, BH, doesn't guarantee the debts associated with Steak and Shake. So like I said earlier, Steak and Shake's debt could allegedly it's indicated to be 184 million. Based on my calculation, I think it's closer to 209 million. But either way, whether it's 184 million or 209 million, that debt, since it's not guaranteed by the parent company, Sardar could simply walk away from that obligation and bankrupt or liquidate Steak and Shake. So that obligation or that debt, which is included in my NAV calculation of 392 million, it kind of puts into question, is it in fact an obligation? Is it in fact a debt that BH is going to have to pay for? And arguably, it's not. And now, that changes the NAV calculation for this particular situation. And so if you were to consider some of the incremental expenses and fees that are likely to occur this year, Sardar, again, allegedly is anticipated to invest $40 million into restructuring Steak and Shake. And on top of the $8 million lawsuit, if you were to, associated with the managers who were unfairly compensated, if you were to consider that $40 million payout, the $8 million payout, and then also if you were to adjust the debt portion of the NAV calculation, you're actually still looking at a BH NAV of $528 million in my calculation, up from my prior estimation of $392 million. So that's really interesting. And again, that compares the $582 million versus my prior calculation of $392 million, compares with the total market capitalization of BH of $196 million as of the date of this recording. So it's certainly very interesting. But now I think, for you guys who are watching this, you guys are thinking, oh, wait a second. So if Steak and Shake does go into bankruptcy, that means that incremental cash flow that comes from that restaurant business is no longer there. So that means he's going to have to make an acquisition, which could likely mean that he's going to have to dilute the treasury shares, which is, I think that's an astute observation to make. So if he did actually go ahead and liquidate those treasury shares, what happens to the NAV calculation? Well, as I said, the share count will increase in a very meaningful way. The share count will adjust to 621,000 versus 346,000 previously. So what that means is the market capitalization is going to be adjusted to 351 million versus the prior market capitalization calculation of 196 million. So even with the liquidation, and then after considering the fact that you're going to have this $40 million payout for the Steak and Shake restructuring, and then the incremental $8 million that's going to be paid out to the 286 managers of Steak and Shake, that leaves a NAV calculation of $528 million versus the post-diluted market capitalization of $351 million. That's still 51% upside. So even after diluting the shares. So now let's assume I'm wrong about Steak and Shake's debt and that the parent company will ultimately be held liable for that obligation, which is contrary to what the most recent 10-K states. But nevertheless, let's actually just play that out. If you were to factor in the $40 million incremental payout for the Steak and Shake restructuring, the $8 million payout for the lawsuit, and still include Steak and Shake's debt, the NAV calculation is $344 million versus my prior $392 million estimation. Now that compares with a post-diluted market capitalization of $351 million. The reason why I'm pointing that out is because if I'm ultimately totally wrong about this, the downside here is about 2%, whereas the upside, if I'm right about the valuation and I'm right that the price will move in tandem with the valuation, the upside is anywhere between 51 to 100%. So it's an asymmetric risk return opportunity here, where the downside is negative 2% versus the upside at 51 to 100%. So it's kind of interesting to think about. And now, with all of that being said, I'm not giving you a thesis. I'm not telling you that this is a compelling investment opportunity. As a matter of fact, I wanted to actually open that up for you, the audience, to be able to decide for yourself, and for you to tell me what you think. I'd love to be able to open this up as a dialogue, where you can tell me yes, no, terrible investment opportunity, terrible idea, terrible situation, or this is quite compelling, this is really interesting, but tell me why. Tell me what your thoughts are, and I'd love to be able to correspond with you about, is this a really compelling investment opportunity? Is there enough margin of safety here? So feel free, and I encourage you to leave comments in the comment section below in this episode. So just wanted to throw that out there. Lastly, I didn't mention this before, but the company does operate with a dual class structure, and there is an arbitrage opportunity as of the date of this recording of about 11%. So remember, A class shares are entitled to the economic benefits of this company, are entitled to 1 vote. The B class shares are entitled to 1/5 of the economic benefits as the Class A shares, but are not entitled to any votes. So when it comes to the fact that there's no votes associated with the Class B shares, I don't know, I can't definitively tell you what is the appropriate discount between A and B, but 11% discount feels somewhat large for that disparity. So I guess you'd have to compare and contrast that against other companies that have a similar dual class structure, and compare and contrast there and see what the discounts historically are. Now, last comment I'd like to make is that I recognize that Biglari Holdings BH is it's kind of a no-name company. It's not many people are talking about it. It's not a Tencent, it's not a Google, it's not an Apple, it's not a Tesla. I would wager that you've never heard of the name Biglari. And so the reason why I bring that up is because some of you may be scratching your heads like, why does he constantly talk about these no-name companies? And the reason why is because I want to bring your attention to one quote that I came across a while ago by Warren Buffett. And he said this: "The best decade was the 1950s. I was earning 50% plus returns with small amounts of capital. You have to turn over a lot of rocks to find those little anomalies. You have to find those companies that are off the map, way off the map. No one will tell you about these businesses. You have to find them." So the reason why I kind of focus a lot of attention on these no-name companies and these smaller cap opportunities is because, these large, ultra large cap stocks, how many people are looking at them? Is there an inefficiency there? Possibly. But relative to these smaller no-name companies where volumes are far less, there's more opportunity for inefficiency here. And I think that's the primary reason why I like talking about these stocks that quite frankly, no one else is really discussing. And so that's kind of why I wanted to, that's kind of why I just wanted to emphasize or bring that up, talk about why I like talking about these smaller opportunities or these smaller cap stocks. So with that, if you thought this was helpful, if you thought this was kind of interesting and you learned something, I'd definitely appreciate you giving us a like, subscribing to the channel. We do have this episode up on our podcast, Get That Bread Value Investing. It's available pretty much anywhere where you find your podcasts. And so find us there as well. I'll see you guys on the next episode. All right. Bye.